June 2026, the median sale price for a home in Union City dropped 7.7% in a single month. Yet, even with that price step, homes are moving into contract in a median of just 15 days, with buyers consistently pushing final sale prices above the original asking limit. These two metrics seem to tell different stories. A price drop of this size usually suggests a market is cooling, but the transaction speed on the ground indicates that competition is actually intensifying. The headline price drop creates a surface level impression of a buyer's market, while the actual transaction speed reveals a much more aggressive reality under the hood. This bar chart shows the month over month decrease, with June's median sold price settling at $1.327 million. But supply explains the real story. Inventory is severely restricted to just 1.76 months, fueling bidding wars that push final sales to 102.1% of asking when you have less than 2 months of available supply colliding with a 2 week pending cycle. Buyers are forced into bidding wars. That pressure drives prices back above asking, largely neutralizing the impact of the initial price dip. To understand how demand absorbs supply, we need to track the physical flow of the market, the pipeline of properties moving from active to pending to close. This flow chart illustrates the specific market input for June. Exactly 33 new listings entered the market, with sellers setting a median asking price of $1.395 million. The throughput was immediate. 26 homes were instantly swept into pending status, while 28 homes moved through to a final close. Even with the price drop, the gap between the new listing median of $1.395 million and the final close median of $1.327 million remains unusually narrow, because buyers are absorbing those 33 new listings almost as fast as they appear. There's no excess inventory left over to actually slow the market down. To put June's numbers in perspective, we have to pull back from a single month and look at the 5 year historical trend. On this 5 year graph, we see that the current $1.33 million median represents a stabilization off recent peak highs. Despite the monthly dip, values remain well above pandemic era lows. The most consistent factor in this market is the supply shortage. For this entire 5 year span, inventory has remained trapped under the 3 month seller's market threshold. This creates a unique pricing environment where the Union City median sits roughly 1.4 times higher than the overall California state median. Structural geographic constraints and proximity to major tech hubs keep this inventory leverage locked in as a long-term characteristic of the local market. For buyers, the lesson is clear that 7.7% monthly dip is not an invitation to submit lowball offers. To compete in a market moving this fast, you must be fully underwritten by your lender and ready to execute a clean contract within that 15-day window. For sellers, while you hold the leverage, you must still navigate the overpricing trap. This diagram shows the risk, with model estimated valuation softening by 2.1% over the last year. Pricing a home even slightly too high can cause it to stall. You have to price to the live market to trigger a competitive bidding scenario. For investors, the 15-day velocity ensures that turnkey properties remain highly liquid assets. The market's structural leverage only benefits those who align their transaction tactics with the specific speed of the current month. Union City remains a tight, fast-moving seller's market, even when the monthly headline price shows a decline. To examine the specific pipeline metrics for yourself, you can download the full June 2026 market report linked in the description. Before making a move, ensure you have a true address specific valuation based on live street level sales data. When the market is moving at 15-day speeds, generic headline data can be misleading. Real-time hyper-local analysis is the only reliable blueprint for a successful transaction.